In April 2026, investors in BlackRock's largest private credit fund asked for $1.2 billion back. The fund could only give them half. The other half was locked inside a structure most investors didn't know existed. After 2008, regulators told banks to stop being so risky. Banks did the only thing banks ever do. They offloaded the risk somewhere quieter. Mid-sized companies still needed loans. Banks couldn't make them anymore. A new industry filled the gap. It had no branches, no tellers, no deposits. It just had money, and a willingness to lend it where banks wouldn't. They called it private credit. For 16 years, almost nobody noticed. By 2026, private credit was a $1.7 trillion industry. Bigger than the entire U.S. high-yield bond market, bigger than most countries' GDP. And the people running it weren't shadowy hedge fund cowboys. They were the most respectable institutions in finance. BlackRock, the world's largest asset manager, bought HPS Investment Partners for around $12 billion when the deal was announced in 2024. Apollo, Blackstone, Ares, every blue-chip name was in. $1.7 trillion. Quietly, with your pension fund's signature on the line. Warning sign 1. The funds promised monthly redemptions on loans that lasted 7 years. Warning sign 2. The funds didn't have to mark anything to market. They decided what their own assets were worth. Warning sign 3. When investors got nervous, the only buyers willing to take these loans off their hands were other private credit funds. The same kind of fund. April 2026. Spooked by AI valuation noise and the energy shock, investors started asking for their money back. BlackRock's HPS Corporate Lending Fund, $26 billion under management, received $1.2 billion in redemption requests in a single quarter. It honored $620 million. It told the rest to wait. Warning sign 1. The funds promised monthly redemptions on loans that lasted 7 years. Warning sign 2. The funds didn't have to mark anything to market. They decided what their own assets were worth. Warning sign 3. When investors got nervous, the only buyers willing to take these loans off their hands were other private credit funds. The same kind of fund. Here's the architecture. There's a phrase in banking: borrow short, lend long. It means you take money that can leave fast, and you lend it to people who pay it back slowly. When it works, you collect the difference. When it stops working, you don't. Private credit is borrow short, lend long, with a new label. The fund tells you, ask for your money, get it in 30 days. The fund's actual investments are 7-year loans to companies that can't repay them early. You're being promised 30 days when the underlying contract is almost 3 years instead of 30 days. 84 months instead of 1. This works perfectly when the redemptions stay small. When 2% of investors want out, the fund pays them from incoming cash flow. When 10% want out at once, the math breaks. If you've ever tried to leave a gym contract early, you've felt the simple version of this. The contract says monthly. The penalty makes it yearly. Now imagine the penalty is the fund decides whether you get your money at all. Liquidity is a promise. The promise can be revoked. Public stocks get priced every second. Public bonds get priced daily. Private credit doesn't. Using its own internal models on its own schedule. Regulators call this mark to model. Outside the regulators, there's another name for it: mark to myth. For 16 years, this was sold as a feature. Lower volatility, steadier returns. It wasn't lower volatility, it was hidden volatility. The line on your statement was smooth because the fund was choosing the line. If your house had no public price for 10 years and you could just write down whatever number you wanted on your net worth, you'd feel rich until the day you tried to sell. That's a private credit fund. Without a market, the price is whatever the seller says, until somebody actually tries to buy. Most U.S. public pension funds now hold somewhere between 5 and 15% of their assets in private credit. Insurance companies hold even more. You probably don't know whether your retirement account is in it. The trustees know. They didn't ask you. This wasn't an accident. After 2010, public market returns kept getting harder to chase. Pension boards needed yield to meet their obligations. Private credit promised it. They allocated. If you've ever signed a 401k form and skipped the fund-by-fund breakdown, most people do, there is a non-trivial chance some portion of your retirement is sitting inside a vehicle that just told its biggest investors to wait. The largest unwitting bet of your retirement may be one you can't even see. BlackRock's HPS isn't unique. It's the first big one to admit. Industry trackers have identified more than 1,000 private credit funds operating with the same liquidity mismatch. The Federal Reserve, in 2024 Financial Stability Writing, called the structure inherently fragile. That phrase is rarely used carelessly by regulators. They wrote it 18 months before the gate closed. Nobody acted on it. The first crack is loud. The 1,000 behind it are louder. In 2008, money market funds and the class of off-balance sheet vehicles failed for the same reason private credit is straining now. They borrowed short, they lent long. When everyone wanted out at once, the math collapsed. Every regulator after 2008 said, "We'll never let this happen again." Then they let it happen again, under a different name. Private credit isn't a new mechanism. It's an old mechanism with a new label. Borrow short, lend long, hide the price. Repeat until somebody asks for their money back at the wrong moment. The crisis you'll watch in the news next quarter was visible in 2010. They just renamed it. 3 questions. Ask them about any retirement account you own. Question 1. What percentage of your portfolio is in alternatives? Private credit, private equity, private real estate? If your answer is, "I don't know," that itself is the warning. Question 2. How long is your money locked up in those alternatives? The fund tells you in the prospectus, and it's never the answer you'd guess. Question 3. When you look at the line on your statement, is it suspiciously smooth? Real markets are never smooth. Smooth is a marketing decision. 3 questions, 5 minutes. They will tell you more about your retirement than the last 5 years of statements combined. Every financial crisis since 1907 has rhymed. Borrow short, lend long, mark to whatever you want. When the music stops, the people who can't get out fast enough pay for the people who could. The names change, the labels change, the mechanism doesn't. If a return looks too good and too steady at the same time, somebody, somewhere, is taking the volatility you're not seeing on your statement. BlackRock's gate is the first one you've heard about. It will not be the last. The next time you log into your retirement account, the number will tell you what they want you to believe. The structure underneath will tell you what's actually true.